Hi again, I'm Michael Carr for Banyan Publishing. Welcome back to the second part of our educational series, How to Read a Stock Chart 101. In this video, I'll be discussing the basic building blocks of chart patterns: trends, support, resistance, and gaps. So let's jump right in. Important charting concepts include the idea of trends, support and resistance, and gaps. Now, these concepts are the basic building blocks of pattern analysis, and they can either be used to identify common patterns or they can be used on their own. The idea of a trend is pretty well understood, but what may not be as well understood is the fact that there are three types of trend. There's an uptrend, a downtrend, and a sideways trend. Now, this is very important to remember because studies show stocks spend about 2/3 of their time on average in sideways trends. So the key to trading is going to be to identify the uptrend and the downtrend, because that's where the money can be made, and the sideways trend can be your signal to watch the stock. Even place your orders in advance for the breakout, because the sideways trend is telling you an up or down trend is about to begin. Now, here's what the trends look like. Up, higher highs, higher lows. Down, the opposite. And then sideways, no real price gains, just moving within a narrow range. The uptrend is defined as generally higher highs and lower lows. Now, with charts, it is very important to remember approximate rules apply. We see here that we have an almost higher high. That doesn't violate the trend. We need to see the follow-up action before we get too excited. Same thing here, where we see an almost higher high. The trend was not broken, and that's what's important to remember, is we may not precisely see higher highs and higher lows on each and every market tick, but the general trend will be higher or lower in the case of a downtrend. Now, a downtrend, same idea. We're going to see the lower lows, the lower highs. We aren't going to get excited about small violations because the trend, the general direction, still remains down until it's decisively reversed. And we'll look at ways of knowing when it's reversed. Here's the sideways trend. It's a consolidation. One way to think of it is to almost think of the market in human terms. This was a strong rally that we saw here on the left side of the chart. After running for an extended period of time at a rapid rate, any normal human is going to need some time to rest. And they may do so by just walking slowly for a moment or two. Well, that's the sideways trend. The market sprinted here, and then it rested up. The sideways trend, very important, because once you see it, you can prepare for the breakout. You can look and say, well, here's a case of a consolidation. Once we break to the upside, I want to be long. We can use trend lines. These are very common in technical analysis, where individuals simply connect the highs or the lows. A downtrend, we connect highs. An uptrend, we connect lows. And when you break that trend line, you expect a trend reversal, but it doesn't always follow that way. Here we have in red the downtrend line. It was broken. We immediately look for the bottom, try to identify an uptrend. But when that uptrend line was broken, all that happened was the pace of the gains slowed. So it's important to remember that the market action dictates what's going on rather than our preconceived notions. Instead of just selling out here and waiting for a downtrend to materialize, we could simply see that the price action negated that break, and we get back into the market and enjoy the upside gains, which were significant in this case. Trendline breaks, as I mentioned, are expected to indicate a trend reversal. But also important concepts include support and resistance, and those are similar to trend lines in that they're lines on a chart. We can find support when we draw lines. That's an area where prices kind of stop falling. In other words, buyers come into the market. Demand increases because that stock price appears to be a bargain. Resistance is an area where a rally stops repeatedly. This is an area where prices stop moving up because sellers come into the market. Holders of the stock become nervous that it's getting too high in price, so to speak. Here's what it looks like on a chart. So the upper line is resistance, the lower line is support. And we see here that when prices ran up to their previous high, so prices, we had an uptrend and then a sell-off. And there were buyers back here at the highs. And what they're doing as prices fall is often thinking to themselves, if I get back to even, I'm going to sell. And that becomes a resistance level because the buyers at this level are selling now that they're even. Then prices fall again. We have the individuals who held on. They saw this price decline. And as prices reach that level, they're getting worried that it may be time to sell again. But there's others who look at it as a bargain. So we have both buyers and sellers coming into the market. And that's exactly what we see in this chart. Sellers got a little anxious, but buyers were right there, picking up the stock as it was sold off. This is Tesla, by the way, so you could see that Tesla was always an emotional stock. And as individuals got nervous when that support broke, buyers came rushing in, and the support did, in fact, serve as an excellent buying opportunity. Broken support, short-lived breaks can be useful. And then again, the support and resistance combine to form a consolidation pattern, and the breakout tells us we have a new trend developing. So we go from the sideways trend to the uptrend. Another important charting concept is gaps. And gaps are an area on the chart where just no trading occurs. This is Tesla. Because there's so much emotion in the stock, we often see prices just race up or down at the open. So a gap is simply an area where often it's caused by news. And if the news is good, the stock will open up above the day's previous high, and the low for the next day here will remain above that high. A low is a break below the day's previous high. So here we see an example of a breakaway gap. We had prices in a consolidation. News came out. The stock rallied sharply. We have a gap. There was no trading at this level. Breakaway gaps is the term for when it breaks out of a consolidation and begins either a new uptrend or a downtrend. A runaway gap is generally the second gap that we see on a chart. So we have here an initial breakaway gap, and then prices drifted higher. News came again 3 months later, that's earnings, and the runaway gap, kind of the halfway point, so to speak. So what we can do when we notice that second gap in this type of a pattern is measure from the previous breakout level to the high, and then project that from the high up to our price target. So runaway gaps, we expect them to be the halfway point of a major price move. An exhaustion gap tells us that's it. This is that same chart of Biogen that we looked at with the runaway gap, and here we have the breakaway, the runaway. The third gap is just exhaustion. This is again an earnings driven move, but it's just the end. Traders have run out of steam, so to speak. Remember, we can humanize the market action at times, and traders have now been running hard for 6 months, and they're out of steam. So we see that the third gap, big gap up, then a sharp reversal the next day, often a signal that the trend has ended. And you don't want to be buying after the exhaustion gap is visible. The exhaustion gap being the third gap on a long-term chart like that. Now, that assumes that the gaps are important. Sometimes a gap on a chart won't mean anything. If you look at a chart like this, this is Honda. It's a Japanese company and it trades in Japan. Well, it's trading in Japan while New York markets are closed. The next morning, we should see a gap to reflect what happened in Japan for this stock. So ETFs or stocks that trade largely on foreign markets will show gaps every day. These gaps have no meaning. We should not try to analyze these for foreign stocks because they simply reflect normal market action. Putting it all together, trends, support, resistance, and gaps are the cornerstones of chart analysis. They combine to form different patterns. We highlighted the consolidation. We'll look at how they combine to form other patterns in the next video in this series. Thank you for joining me.